In the past year, the world has witnessed a series of economic shocks that have left policymakers scrambling and markets in turmoil. The most striking event was the unexpected collapse of a major European bank, which sent ripples through the global financial system. Known as the maximum pressure strategy, this approach was intended to curb inflation by tightening monetary policy aggressively. However, it inadvertently exposed deep vulnerabilities within financial institutions, leading to an unprecedented liquidity crisis. While many believed this strategy would stabilize the economy, the reality was far more complex. We must delve into the underlying dynamics of this strategy to understand why it failed and what it means for the future of global economies.
The maximum pressure strategy is grounded in a widely accepted economic principle that tightening monetary policy during periods of high inflation can stabilize prices and restore economic balance. Most people believe that by increasing interest rates, central banks can curb spending and borrowing, thus reducing inflationary pressures. This conventional wisdom has been the cornerstone of economic policy for decades, used by major economies like the United States and the European Union. However, what is often overlooked is how this approach affects financial institutions and markets that are highly sensitive to sudden changes in interest rates. The assumption is that markets will adapt, but the reality is often more disruptive, as seen in the recent banking collapse.
Beneath the surface of the maximum pressure strategy lies a complex dynamic, often neglected: the fragility of financial institutions in the face of sudden interest rate hikes. These institutions, including banks and investment firms, rely on stable rates to manage their portfolios and liabilities. When rates rise rapidly, it disrupts their balance sheets, leading to liquidity issues. This fragility is compounded by the interconnectedness of global finance, where a shock in one region can quickly spread to others. The recent collapse of a European bank was not simply a failure of policy, but a revelation of the systemic vulnerabilities that can arise from aggressive monetary tightening. This hidden dynamic challenges the notion that central banks can control inflation without unintended consequences.
The central question we must explore is, why do aggressive monetary policies, like the maximum pressure strategy, sometimes destabilize rather than stabilize economies? While they are designed to control inflation, their implementation often triggers unintended consequences that ripple through financial systems. This video will dissect the strategic misalignments and systemic vulnerabilities that arise when central banks pursue aggressive rate hikes. We will explore how these policies impact financial institutions, market behavior, and ultimately, economic stability. By examining these dynamics, we aim to uncover the deeper economic forces at play, challenging the conventional wisdom that higher interest rates are always the solution to inflationary pressures.
The strategic question we face is, how can central banks balance the need to control inflation with the risk of destabilizing financial markets? As economies become more interconnected, the impact of monetary policies extends beyond national borders. Central banks must weigh the immediate benefits of rate hikes against the potential for triggering global financial instability. This video will examine the strategic considerations central banks must take into account when crafting their policies. We will explore how they can navigate the delicate balance between inflation control and market stability, recognizing the potential for unintended consequences and systemic risks.
To understand the maximum pressure strategy and its implications, we must delve into several layers of economic analysis. We will begin by examining the historical development of monetary policies and how they have evolved over time. Next, we'll explore the structural forces within the financial system that are affected by these policies, including interest rate dependencies and market dynamics. Additionally, we'll analyze the policy decisions made by central banks and the strategic incentives behind them. Finally, we'll investigate hidden systemic risks that arise from these strategies and compare them with global economic practices to provide a comprehensive understanding of the potential outcomes. Understanding the maximum pressure strategy requires dissecting multiple layers of economic dynamics. At the surface, it appears to be a straightforward monetary policy designed to combat inflation. However, beneath this lies a web of interconnected economic factors. We must consider the historical context of previous monetary regimes and how they inform current strategies. Additionally, the structural dependencies within financial markets play a critical role, influencing how policies are implemented and their subsequent impact. Furthermore, the strategic incentives of policymakers and financial institutions must be analyzed, as they often drive decisions that have far-reaching consequences. By peeling back these layers, we can gain a deeper insight into the true nature of the strategy.
The historical origins of the maximum pressure strategy can be traced back to the evolution of monetary policy in the late 20th century. In response to the stagflation of the 1970s, central banks adopted aggressive interest rate policies to curb inflation, a strategy famously implemented by Paul Volcker at the Federal Reserve. This approach laid the groundwork for future monetary policy frameworks, emphasizing the importance of controlling inflation through interest rate adjustments. Over the decades, this strategy became a cornerstone of economic policy, influencing how governments and financial institutions managed economic cycles. The success of these policies in stabilizing inflation led to their widespread adoption, despite the underlying complexities and potential risks they posed to financial stability.
As monetary policy evolved, the maximum pressure strategy became increasingly refined. In the 1990s and early 2000s, central banks adopted inflation targeting, which provided a more structured approach to managing economic stability. This period saw a shift towards transparency and communication, with central banks like the European Central Bank and the Federal Reserve using forward guidance to influence market expectations. Financial innovations, such as derivatives and complex financial products, also played a role in shaping how monetary policies were implemented. These developments marked a significant evolution from earlier, more opaque practices, highlighting the ongoing adaptation of monetary strategies to meet the demands of a rapidly changing global economy.
Key policies associated with the maximum pressure strategy include aggressive interest rate hikes and quantitative tightening. Central banks, like the Federal Reserve under Jerome Powell, have implemented these policies to rein in inflation and manage economic growth. However, the impact of such policies extends beyond immediate economic indicators. They influence currency values, capital flows, and global trade balances, often leading to unintended consequences such as currency volatility and trade tensions. By examining these key policies, we can better understand the broader implications of the maximum pressure strategy and its potential to reshape global economic dynamics.
Throughout recent history, key turning points have defined the global economic landscape. The 2008 financial crisis, triggered by the collapse of Lehman Brothers, exposed vulnerabilities in the financial system, leading to sweeping regulatory reforms. The Eurozone crisis in the early 2010s underscored the fragility of monetary unions without fiscal unity, compelling nations like Greece to adopt austerity measures. More recently, the COVID-19 pandemic acted as a catalyst for unprecedented fiscal and monetary interventions, shifting economic paradigms towards more expansive policies. These events have reshaped how governments and central banks approach economic stabilization, highlighting the delicate balance between growth and sustainability. Understanding these turning points is crucial, as they reveal the underlying pressures that could potentially break economies under the maximum pressure strategy.
Today, the global economy stands at a precarious juncture. Inflation rates have surged, reaching levels not seen in decades, driven by supply chain disruptions, energy shocks, and post-pandemic demand surges. Central banks, like the Federal Reserve under Jerome Powell, grapple with the challenge of raising interest rates to combat inflation without stifling growth. Meanwhile, geopolitical tensions, such as those involving Ukraine and Russia, have exacerbated economic uncertainties. Nations are increasingly resorting to protectionist policies, complicating international trade dynamics. These conditions have set the stage for the maximum pressure strategy, which could exploit these vulnerabilities, threatening to push economies towards breaking points.
Understanding the current landscape is crucial for anticipating the potential impacts of such strategic economic maneuvers. In the intricate web of global economics, several main actors play pivotal roles. Governments, with their fiscal policies, aim to stabilize economies and stimulate growth. Central banks, like the European Central Bank under Christine Lagarde, use monetary policy tools to control inflation and support financial systems. Financial institutions and corporations drive investments and innovations, but also bear the risk of speculative bubbles. Investors, both individual and institutional, influence market dynamics through capital allocation. These actors operate under strategic assumptions about economic conditions, shaping policies and financial structures. Their decisions can either mitigate or exacerbate economic vulnerabilities, making them key players in the maximum pressure strategy. Understanding their roles provides insight into how pressures can accumulate or be alleviated within the economic system.
The strategic assumptions guiding economic actors are based on expectations of market stability, interest rates, and growth trajectories. Governments, like those led by Donald Trump in the USA, often assume that fiscal stimulus will spur economic growth, balancing short-term deficits with long-term gains. Central banks predict that controlled inflation will maintain purchasing power and economic stability, relying on interest rate adjustments as a primary tool. Financial institutions expect that market trends will continue, driving investments in growth sectors. These assumptions shape policies and decisions, but they also carry risks. If market conditions deviate from expectations, these assumptions can lead to miscalculations, exacerbating economic vulnerabilities and setting the stage for strategic maneuvers under the maximum pressure strategy. Economic policies, whether fiscal or monetary, have profound impacts on global markets. Fiscal policies, such as tax cuts or increased government spending, aim to stimulate economic activity but can lead to rising deficits and debt levels. Monetary policies, managed by central banks, influence interest rates and money supply. For example, the European Central Bank under Christine Lagarde has utilized negative interest rates to encourage lending and combat deflationary pressures. However, these policies can also create asset bubbles and distort financial markets. The maximum pressure strategy exploits these policy impacts by targeting economic vulnerabilities, potentially leading to market instabilities. Understanding policy impacts is essential to anticipating how strategic economic pressures can be applied to influence or destabilize economies. Debt accumulation is a critical structural factor influencing economic stability. As governments and corporations take on more debt, they face increased financial obligations, which can constrain future fiscal and investment capabilities. The United States, for example, has seen its national debt surpass $30 trillion, raising concerns about sustainability and future economic flexibility. High debt levels can lead to increased borrowing costs and limit the ability to respond to economic crises. Moreover, reliance on debt financing can create vulnerabilities, especially if economic growth slows or interest rates rise. The maximum pressure strategy could exploit these vulnerabilities by triggering debt crises, forcing economies to choose between austerity and default. Understanding debt dynamics is crucial for assessing how economic pressures can be strategically applied to influence global economic outcomes. The mechanism of debt accumulation involves borrowing to finance expenditures that exceed revenue. Governments issue bonds to raise funds, relying on future tax revenues to repay these obligations. Corporations issue debt to finance expansions, acquisitions, or operations, expecting future profits to cover interest payments. However, excessive borrowing can lead to a debt spiral, where new debt is used to pay existing obligations, increasing financial risks. Interest rate hikes exacerbate this situation, raising borrowing costs and straining budgets. The maximum pressure strategy could leverage these dynamics to destabilize economies, as rising debt levels force difficult fiscal decisions. Understanding this mechanism is key to analyzing how strategic pressures can manipulate debt-dependent systems, potentially leading to economic crises if not managed effectively.
Historical evidence of debt-related crises provides insights into the potential outcomes of current debt dynamics. The Latin American debt crisis of the 1980s was a result of excessive borrowing and rising interest rates, leading to defaults and economic turmoil. Similarly, the Asian financial crisis of 1997 was fueled by high levels of foreign debt and speculative investments, resulting in currency devaluations and widespread financial distress. These historical cases demonstrate how unchecked debt accumulation can destabilize economies, prompting international interventions and austerity measures. Today, with global debt levels at unprecedented highs, these lessons underscore the risks associated with over-reliance on debt financing. The maximum pressure strategy could exploit these vulnerabilities, suggesting that without prudent debt management, history may repeat itself.
Capital flows, the movement of money for investment, trade, or business production, play a significant role in shaping economic conditions. Large inflows of capital can stimulate economic growth by funding infrastructure projects, enhancing productivity, and creating jobs. However, these flows can also lead to overheating economies and asset bubbles. Sudden reversals, where capital exits rapidly, can cause financial instability and currency devaluation. The Asian financial crisis of 1997 exemplifies how volatile capital flows can destabilize economies. The maximum pressure strategy could manipulate capital flows to exacerbate vulnerabilities, triggering economic disruptions. Understanding capital flow dynamics is essential for assessing how strategic pressures can be applied to influence economic stability, highlighting the need for effective management of cross-border capital movements.
The operation of economic systems under the influence of capital flows and debt dynamics reveals the complexity of managing global economies. When capital inflows are high, economies can experience rapid growth, but without proper regulation, this can lead to asset bubbles. Conversely, when capital exits, economies face liquidity shortages and financial stress. High debt levels exacerbate these conditions, as servicing debt becomes more challenging with changing capital dynamics. The maximum pressure strategy could exploit these interactions by influencing capital movements and debt perceptions, destabilizing economies. Understanding how these systems operate is crucial for policymakers to design resilient economic frameworks that can withstand strategic pressures, ensuring stability and sustainable growth in an interconnected world.
The maximum pressure strategy, often employed through economic sanctions, has profound implications for the targeted economies. This approach aims to cripple a nation's financial system by restricting access to international markets, limiting currency reserves, and hindering trade. Countries like Iran and North Korea have experienced the harsh realities of these policies, leading to significant economic downturns, hyperinflation, and decreased standards of living. Moreover, the ripple effects are felt globally as supply chain disruptions can increase commodity prices. For instance, sanctions on key oil-producing nations can lead to global oil price hikes affecting transportation and manufacturing sectors worldwide. Critics argue that while the strategy aims to coerce policy changes, it often exacerbates humanitarian crises, as the most vulnerable populations bear the brunt of economic hardships.
Currency dominance plays a pivotal role in the global economy, especially when it comes to the maximum pressure strategy. The dominance of the U.S. dollar as the primary global reserve currency gives the United States unparalleled leverage over international trade and finance. Countries are compelled to hold substantial reserves in dollars to facilitate global transactions. This dominance allows the U.S. to exert pressure by restricting access to dollar-based transactions, effectively isolating targeted economies from international markets. The consequences are severe, as seen in nations like Venezuela, where currency restrictions have led to economic collapse. However, emerging economies are challenging this dominance by pushing for a more diversified reserve system, potentially reducing the dollar's hegemonic influence and reshaping global economic dynamics.
The mechanism of currency dominance is rooted in the trust and stability associated with the currency in question. For the U.S. dollar, its widespread use is supported by the economic might of the United States and the perceived stability of its financial institutions. Countries prefer holding dollars due to its liquidity and the vast market for dollar-denominated assets. Historical examples include the post-World War II Bretton Woods system, which cemented the dollar's role as the central pillar of international finance. This dominance enables the U.S. to impose sanctions effectively, as seen in the case of Iran, where dollar transactions were severely restricted, crippling its economy. As a countermeasure, some nations are exploring alternative currencies like the euro or even digital currencies to reduce their dependence on the dollar. Currency dominance extends beyond economic transactions. It influences geopolitical relations and international policies. The U.S. dollar's dominance enabled the United States to exert significant influence over international organizations, such as the IMF and World Bank, where funding and financial support often align with U.S. strategic interests. This influence is not just economic, but also political, as it affects bilateral relations and trade agreements. For instance, countries dependent on dollar transactions might align their foreign policies with U.S. interests to avoid sanctions or secure favorable trade terms. Meanwhile, emerging economies like China are attempting to counterbalance this influence by increasing the yuan's role in international finance. This ongoing shift in currency dynamics could reshape power structures and redefine global economic alliances. The interaction between structural factors, such as debt accumulation, financial leverage, and currency dominance, creates a complex web of economic dynamics. When these factors converge, they can amplify economic vulnerabilities and lead to systemic crises. For example, high levels of debt, coupled with currency volatility, can lead to financial instability, as seen in the Asian financial crisis of 1997. At the same time, financial leverage can exacerbate the impact of currency fluctuations, as institutions heavily reliant on borrowed capital face increased risks. These factors together can create a feedback loop, where initial economic pressures trigger further instability, leading to a cascading effect across global markets. Understanding these interactions is crucial for policymakers to devise strategies that mitigate risks and enhance economic resilience. Comparing the current economic landscape to past financial crises reveals both striking similarities and notable differences. The 2008 global financial crisis, for instance, was marked by excessive leverage and complex financial products, which led to a systemic collapse. Today, while leverage remains a concern, the rise of digital currencies and decentralized finance presents new challenges that were not present in 2008. Similarly, the currency dominance dynamic is reminiscent of the Bretton Woods era, yet today's multipolar world with emerging economic powers like China offers a different context. These historical comparisons underscore the cyclical nature of economic systems while highlighting the unique challenges of the present era, such as technological disruptions and geopolitical tensions. At the heart of the maximum pressure strategy lies a strategic paradox. The very tools designed to enforce economic stability and international compliance can also sow the seeds of systemic instability. Sanctions, for example, while aimed at altering state behavior, can lead to unintended economic isolation, pushing targeted nations to form alternative alliances and economic blocs. This can inadvertently weaken the sanctioning country's influence over time. Moreover, reliance on currency dominance as a tool of pressure creates vulnerabilities, as it encourages other nations to seek currency diversification, potentially eroding the dominant currency's value. Thus, while short-term objectives may be achieved, the long-term consequences could undermine the global economic architecture that the strategy seeks to protect. If you found this perspective valuable, consider subscribing. Let me know your thoughts in the comments. I read every one of them. Thank you for watching.